Mexico just made a decision that could permanently alter the silver supply chain for an entire continent. The Mexican government has announced a sweeping new framework targeting silver export volumes, placing restrictions on raw ore shipments, refined silver bars, and concentrate exports destined for North American processing facilities. The announcement didn't make front-page news. It didn't trend on financial Twitter. Most mainstream financial media buried it beneath earnings reports and central bank commentary. But here's what those headlines missed. Mexico is not just a silver producer. Mexico is the single largest silver-producing nation on the planet. In the most recent full production year, Mexico produced approximately 194 million ounces of silver. That's roughly 24% of total global mine supply coming from one country. A significant portion of that supply flows directly into North American industrial and investment demand chains. When the world's largest silver producer restricts exports, the word disruption doesn't begin to cover what's actually happening. You're not looking at a supply hiccup. You're looking at a structural severing of the supply architecture that North American manufacturers, mints, and industrial processors have built their entire procurement models around. There's a specific reason Mexico made this decision right now. It connects to a broader resource nationalism trend that's been quietly accelerating across Latin America for years. Once you understand the geopolitical forces driving this policy shift, today's announcement stops looking like isolated news. It starts looking like the opening move in a much larger restructuring of how critical metals flow around the world. Let's break down exactly what was announced, because the coverage that does exist has been imprecise. The Mexican government classified silver alongside lithium as a strategic national resource. That single classification triggers a cascade of automatic policy consequences most outside observers haven't fully processed. First, raw ore and silver concentrate exports now require individual government authorization on a shipment-by-shipment basis. Every significant export now needs a separate approval from the Ministry of Economy. Second, volume caps on refined silver bar exports have been implemented. Industry analysts estimate this represents a reduction of between 15 and 22% from recent average monthly export volumes. Third, and most consequential, a preferential domestic processing requirement is now in effect. A defined percentage of silver mined in Mexico must now be processed inside Mexico before it can leave the country. The third point dismantles the entire North American supply chain model. Mexican mines extract ore. That ore ships as concentrate to smelters in Montana and Texas, and those facilities refine it into silver that enters the broader market. The new processing requirement doesn't just reduce export volumes, it challenges the core economic logic the entire supply chain was built on. Mining companies now face a binary choice. Either build domestic processing capacity inside Mexico, which takes years and hundreds of millions in capital, or reduce production entirely. Neither option resolves the structural shortage for North American buyers in the near term. Neither option is fast. The United States consumes approximately 150 million ounces of silver annually. Industrial applications account for roughly half of that. Solar panels, electronics, electric vehicle components, medical devices. Industry estimates suggest Mexico is the origin of between 35 and 45% of silver that ultimately enters U.S. industrial supply chains. That is not a marginal input, that is a foundational dependency. Now let's talk about why Mexico made this move. Because resource nationalism is poorly explained in most financial media. Resource nationalism emerges when a government looks at its mineral wealth and concludes that foreign corporations are capturing more of the economic value than domestic citizens are. It's a political calculation as much as an economic one. Mexico watched Bolivia nationalize lithium. It watched Chile assert state control over copper. Each regional precedent made the next step easier to justify politically. Beyond politics, Mexico has a clear economic rationale. When they export raw concentrate, the value-added processing happens in the United States. The employment, the tax revenue, the economic activity, it stays in North America, not Mexico. By forcing domestic processing, Mexico captures more of the value chain. This is precisely the logic Indonesia applied when it banned raw nickel ore exports in 2020. Indonesia's ban caused severe short-term supply disruptions, a dramatic nickel price spike, and sent shockwaves through the global electric vehicle supply chain. Mexico has studied that playbook and is applying it to silver. Now, here's what makes this more acute for North American buyers specifically. Indonesia's nickel ban primarily affected Asian supply chains. Alternative sources cushioned the blow for Western buyers. Mexico's silver restrictions have no such cushion for North American buyers. The alternatives are Peru, which faces its own political instability. China, whose silver is consumed domestically. Russia, which is inaccessible under current sanctions. There is no quick substitute. New mine development in the US, Canada, or Australia takes years. Redirecting silver flows from other global destinations requires significant price premiums. The historical parallel that matters most here is rare earths in 2010. China controlled 97% of global rare earth production and implemented export quotas that triggered an immediate violent repricing across every rare earth element. Neodymium went from $20 per kilogram to over $400 within 18 months. Dysprosium moved from $100 to over $2,000. These weren't marginal moves. They were policy-driven demand shocks hitting buyers who assumed continued access. The market response followed a four-phase sequence. Phase 1, immediate price spike as buyers scramble for inventory. Phase 2, partial pullback as consumption is reduced and inventory is drawn down. Phase 3, a sustained price plateau significantly above pre-restriction levels. Phase 4, very gradual normalization as new supply sources develop over years. Prices never returned to pre-restriction levels. That is the honest historical record. Silver differs from rare earths in one critical way. Silver carries dual demand, industrial and investment. No one stores neodymium in a vault. Silver functions as both an industrial input and a monetary asset. When supply gets restricted in a material that also functions as a store of value, you get two simultaneous demand pressures operating on a shrinking supply base. Industrial buyers competing with investment buyers for a reduced pool of available metal. That combination has historically produced the most significant price outcomes in silver specifically. Now here is the strategic framework for how to read this situation going forward. For industrial buyers, the immediate question is operational. How much Mexican origin silver is on hand or under existing contracts? What does the force majeure language in your supply agreements actually say? These questions need to reach senior leadership this week, not next quarter. For investors holding physical silver, the structural case just got stronger. Less supply from the world's largest producer meeting, growing industrial demand from the energy transition, with investment demand that spikes when constraints become visible. For mining equity investors, geography now matters more than operational efficiency. Producers operating in the US, Canada, Australia, and Peru become more strategically valuable as buyers diversify away from Mexican sourcing. Watch three signals as this develops. First, formal statements from major silver-consuming industries. When electronics manufacturers or solar producers begin lobbying for trade intervention, the disruption is being felt operationally. Second, the US and Canadian government response. A formal trade challenge signals prolonged uncertainty. Silence signals the new supply reality is being absorbed as permanent. Third, silver lease rates. When physical silver becomes scarce, lease rates rise. A sustained spike is one of the clearest signals that the physical market is actually tightening. The Mexico announcement is real. The structural dependency is real. The historical pattern for how policy-driven supply restrictions develop is documented and consistent. What isn't certain is the timeline and the magnitude. Resource nationalism policies have been reversed before when domestic economic pain or diplomatic pressure changes the political calculation. Mexico depends on mining royalties and foreign investment. Restrictions that reduce that capital create their own political costs over time. This is not a one-way street with a guaranteed destination. But it is not ignorable either. The policy framework is in place, the supply chain vulnerability is structural, and the market is still in phase 1 of a sequence that historically takes years to fully resolve. The silver market is sending a clear signal. The only question is how many people are reading it clearly before the rest of the market catches up.